having someone who's employed by the White House on the Fed is not normal. And it's definitely like a move on the spectrum towards less independence. And when the president of the United States says, I want to get a majority on the Fed, like it's not even, like they're not even pretending. It's just, I want to control the Fed, and that means lower rates. I think honestly, like inflation targeting in the US is kind of dead. Like if you look at it now, for years, and this is like before Trump, before tariffs, they're forecasting inflation above target in their SEP, and they were cutting at one point like a year ago. So uh, I would say they don't really care about 2%. If inflation picks up, because then you have then you have like a little bit more of a mini Turkey Erdogan situation where, orthodox economics suggests that you should be doing one thing and you're going to be doing something completely the opposite.
You're watching Excess Returns. I'm Matt Ziegler. I think this is not Brent Donnelly, but I'm going to have to check because I'm getting weird Twitter DM solicitations.
I love it. And just in case people don't know what he's talking about, so people create fake profiles of people that have a lot of followers on Twitter. And normally when someone makes a fake one of me, it'll be like Brent Donnelly or like some kind of thing that's pretty close. And someone created a profile of me to try to like scam people. And it's like Brute Danaloo or something like that. It's not even close to being my name. So I had to applaud them for their lack of effort.
Credit where credit is due.
Yeah. It's so bad. It's amazing.
It's so bad. It's amazing. No, this is the real Brent Donnelly. We got Alpha Trader. We got 50 trades in 50 weeks. We've got more books too that I'm not going to pull up for the sake of time. But I'm excited to be back with you. I'm throwing us right into the deep end. I want to talk about the reacceleration that wasn't. I love this framing so much. Walk me through the August reacceleration thesis, how you knew when to abandon it when the data didn't cooperate with you.
Yeah. So generally just for people that don't know my stuff, my time horizon is pretty short in terms of the risk that I take, but I look at the big picture macro. So what I'm trying to do is like the current price is an equilibrium based on all known information. And then what I'm trying to suss out is what new information will move the price the most based on like positioning and, just sensitivity to whatever regime we're in and things like that. And so there was a moment there. So one thing that I'm still not sure about, I would say, is the interaction between labor demand and labor supply. So most economist models are very labor demand focused and just generally very demand oriented because supply just mostly hasn't mattered for the last 30 years. Supply has been reliable, and it would be like, you don't look at the supply of Bitcoin to guess where Bitcoin's going. You look at the demand. But there's been some unique situations like 2021 where there was a massive shortage of labor where supply became super important. And I think that's kind of happening now again with immigration crackdowns in the US, and then a similar but different thing happening in Canada and other places, right? The politics of immigration have just flipped everywhere. That you can have a low non-farm payrolls number simply because not enough people are looking for jobs. So if you take it to the extreme, what you would have is a very low unemployment rate and very low non-farm payrolls reports because nobody's looking for jobs because everyone already has a job. And all the people that do the low wage work are being extradited. So they're not finding jobs. Obviously, they're losing jobs. And so my theory was that this is more of a labor supply shock than a labor demand shock. However, as I said in my write-ups, like a lot of these views, I'll kind of like put it on like a hat and see how it feels, and then be very quickly. It's the concept of like strong views weakly held, which is essentially saying like, okay, I'm going to have this strong view, but if I'm going to be ultra Bayesian. Like the second I see something contradictory, I'm going to get out of Dodge. And so then the week that I kind of tried on this, like it's a labor supply story and we're going to reaccelerate idea, we literally had 4 labor market numbers in a row that were pretty weak. So, you can still argue the supply side, but also the demand side is looking pretty weak. And so a reacceleration without labor demand rising is kind of difficult. So the good thing was though that, and actually I think there's a lesson in this. It's not just, it's not purely luck, because I try to determine like, okay, good decision, bad outcome, or like bad decision and good outcome, and I got lucky. But I think in this case, because I said ex ante, this is my plan, it was good decision, good outcome. So my expression of that view was, okay, we're going into like all this labor market data plus some CPI and and core PCE was last week, and then PPI data. And so what I want is some kind of combo that will protect me a little bit if I'm wrong. So what I felt like was, if you have a Fed that's being neutered and they're going to cut no matter what. So normally Fed policy is conditional on the economy, and now it's not. um, so if you have a world where you could have a reacceleration and a Fed cutting into that, that's super bullish gold. And then a reacceleration in general would be bearish bonds. So I bought gold calls and I bought TLT puts, and the TLT puts went to 0, but the gold calls, like, I mean, I sold them at 5x. They went like, they actually 9x'd. But so that kind of goes, though, the lesson I think from that is a really cool essay is Dalio's original essay about the all-weather portfolio. And like what he was trying to do, I know you know this, but in case people don't know it,
No, tell this.
um, is what he is trying to do, or what he was trying to do, is create a portfolio that's not contingent on one specific economic forecast. So if you can, I mean, obviously that's difficult to do, or everyone would just do that, but there are ways to construct a portfolio that can be like, I think all weather is too much to ask. Like that's just, to me, that's too hard. But what you can do is say like, okay, these are like the main base case weather scenarios that I'm expecting. And so what's a portfolio that will make money in aggregate across all of those outcomes? And if you have a reacceleration, that's bullish gold. And then if the economy or rates shit the bed, then usually that's bullish gold as well. So, but I think I could have won on both if I was right about the data being more, like the data being stronger. I think gold would have still gone up, because the market would have said, well, the Fed's cutting into this strong data, which is inflationary, sell the back end, buy gold kind of thing. But anyways, I think the two takeaways from it was, one, this is like I think one of my main edges is I just don't commit religiously to anything. Like I'm so agnostic that sometimes it can be confusing, and I have to make sure I'm explaining myself, because like last week I was bullish and this week I'm bearish. But I kind of learned that a little bit from two things. One, from just losing money, having the same view all the time. Like in 2006, 2007, there was a bubble in carry, and I was just short dollar yen and Aussie yen all the time. And it eventually collapsed, but I had some very painful times in there for about 18 months. And actually my boss and I were always the same way. And lucky for me, I wasn't like the manager. I wasn't the guy running the thing, but he actually got fired because he just was losing money for too long on the same idea. So I kind of learned like just being agnostic and flexible is better than having like this core view that you religiously commit to. And then the second thing is, when I was like, I guess I was like in my 30s, and I started to go to meetings with more senior PMs at hedge funds, I got it in my head to ask them, hey, like, okay, you work for Paul Tudor Jones, or you work for Dalio, or you work, well, not Dalio, but you work for whatever hedge fund guy, Louis Bacon or whatever. What do you think it is that makes him really good? And literally every single person said, he'll be bullish on the morning risk call, and when I look at his book at the end of the day, he's short. Like, just that ability to just say, I don't care. And I mean, I think that's kind of like a lesson from reminiscences of a stock operator as well, is like, I don't really care whether I think, crypto's a Ponzi scheme or Tesla's overvalued or what. I'll be long Tesla one day and short the next. And I'm just trying to make money, and not necessarily like have a core religious view about the economy or about any securities in particular.
Go specifically to the GLD and the TLT choices that you made in this setup. Why those two? Why weren't you looking anywhere else? Why wasn't Tesla in the mix or anything else in the world?
So it kind of just rolled out. So like a lot of times people will say like, where do you find trade ideas? And generally I feel like I'm not really looking around going like, okay, I need a trade idea. What am I going to do? It's more like I'm just absorbing all this information, like the fire hose of, Substacks and Bloomberg and Reuters and all that. I have 200 client chats, which is a big source of, information and ideas and stuff. And as I absorb that, it just like, I think it's like the pattern recognition machine starts kicking in and you just start seeing, okay. And so it was basically a textbook setup of you have potentially an acceleration in growth with an extremely dovish central bank. And like, if you're reading like a finance textbook when I was 23, you'd say, okay, what do you do? Well, you sell the back end and buy gold. And then for me, then there's essentially like a structuring question. Like, do I just buy gold? Do I buy like a levered gold ETF? Do I buy calls? And that generally for me is I have, so I have like an entry point, a direction, a destination, and a timing when I think that destination is going to be reached. And then the real way that you do it, if you're not lazy, is you put that all in a spreadsheet and you say, okay, if I buy this GLD call, this GLD call, this GLD call, what's that going to pay based on my expectation of the path and the destination? And if I buy GLD with a stop loss here, and each one I'm risking whatever X amount of dollars, and then you can see, okay, this is the optimal structure. So that's what I do. Sometimes I kind of know, like, because I can just see like, okay, gold at that point hadn't moved in a long time. It was coiling into this like triangle. So I knew gold vol was super low relative to what it could realize if it broke out. And so I'm kind of looking at like, okay, what is current realized and implied vol? And then like, what's my expectation? And usually, so for events and things like that, the vol market is very efficient, and usually buying events is a bad trade in general because events are overpriced because it's hard to risk manage them as an options market maker. But things like if you think a technical level break could trigger a rise in volatility, that's not priced into the options market. So that was the case here. Like gold was like also like literally straight out of a textbook, forming like this ascending triangle it was right in the apex. And so it was a good setup for that. And then on the bond side, essentially I was going to get actually less leverage by doing an option because I could have done way more TLT, but I knew that if I was wrong on the TLT, it might be hard to stop out because there was like 4 economic data points in that window of like, I think it was August 30th. I was doing the trades and I bought September 12th expiry for the options. And in that window, I think there was 4 major economic data points. And like gold, you can get out. Like if CPI is strong, gold flickers all over the place, but TLT just gaps. So I didn't really know if I could, like, if I sold X amount of TLT, whether I'd be able to risk manage it. So that's why I structured the TLT side as an option, even though if I was right, I would have made less money. It was like that I can sleep at night. And also being short bonds when you're in bed is just always a bummer in case like headlines come out. There's always like some weird convexity there that you wake up and there's like a strike, some kind of geopolitical strike or whatever. And that's not good. I'm always like, I'm very, like, I have too much risk appetite, but I'm extremely scared of blowing up. So there's like kind of this contradiction in my worldview, I guess, is that like I love taking tons and tons of risk when I'm sitting at the desk and I can put automated stops in the machine, but I hate having massive risk overnight. So a lot of times I'll reduce my risk when I leave as well, just because you just don't want to ever lose 20% of your account by accident. It's too upsetting.
These are the things. So speaking of things that get you out of bed at night and don't get me out of bed at night, but I'm always, I come to you for the FX stuff. I come to you to see the world through that lens. It's one of my favorite reasons to read you. That's one of my favorite parts about how you make me think about this thing that I don't want to think about because it would get me out of bed in the middle of the night. You've called FX the exhaust valve for Trump's tariff policies. And I honestly, it feels a little bit more like one of those like chopped Camry mufflers on some like cruiser in suburban America. But you're saying it's an exhaust valve. What does that mean? Explain the framework FX as the exhaust valve.
Well, you know what the funny thing is that when I said that back in the day, it was right, but I feel like it's kind of lost its mojo because essentially what happened was when the tariffs came out, people were, first of all, the market was massively long dollars. So that's like an initial conditions thing, which is kind of like to Nasib Taleb's anti-fragile or whatever, is that like the starting conditions of the system determine how it handles a shock. So a dollar negative shock was a huge deal in like April when everyone was massively long dollars. And then also people didn't really know what to do with the tariff thing. So instead of like, if you're a foreign pension fund, this is specifically the pension funds who have like a really huge impact on the FX market. They didn't really want to go underweight USA because MSCI World is 72% USA, which is insane. But anyways, that's another story. And so if they go below benchmark, they have a lot of career risk and they just have a lot of like, I'm going to look bad risk. So what they tend to do if they're less bullish or they're nervous about US geopolitics or whatever is they hedge. They do the FX hedge. And so that was like a massive thing in April. If you look at like the Danish pension funds or whatever, they all went from say 60% to 75% or 61 to 72% and things like that. Like teachers in Ontario teachers sold like $50 billion, mostly dollar CAD after Liberation Day. And so again, what they didn't really want to like sell their NASDAQ too much. They might go from overweight to benchmark, but they didn't want to sell their NASDAQ because it's just too uncomfortable to be underweight tech in this world. But what they could do is sell their dollars. So you saw that, and we saw like a 10% drop in the dollar. But now the system is just completely different. The market's short dollars. And now the pension funds, having done this massive one-off, are just not as comfortable doing more because now, again, you're getting to the point of like, you're going way more hedged than your peers. And so it's risky now to hedge more dollars. And there's been a lot of things have changed too. Like really a big part of the trade at Liberation Day was like exit US and buy Europe. And like if you bring up a chart of like DAX futures minus QQQ or whatever, and then overlay it against Eurodollar. So essentially like Germany outperforming, it's like, and Eurodollar's up like that. And then that DAX QQQ thing is like this, because people kind of thought the AI CapEx cycle might have peaked and like peak USA, and just like all of that was wrong. So again, now I'm pretty agnostic on the dollar. I'm less sure that honestly that the next 5% is down because you've had all this selling and the thesis like now feels a little bit stale. Like the money flow. So one thing I look at, this will be a little bit too in the weeds, so I'll try and keep it short. But if you look at what each currency does by time of day, so like what does dollar yen do in Asia? What does euro dollar do in Asia, in Europe and in New York? In April and May, euro dollar literally pretty much went up every single day in Asia. And so did gold. So, central banks and Asian central banks in China were just buying euros and buying gold every single day. And now that's completely stopped. And so that flow stopped. But one thing that hasn't stopped is money flowing into US equities. So, and there's a lot of also these deals like SoftBank says they're pledging, $50 trillion. It's all basically bullshit. Like the numbers are bullshit, but the direction is not bullshit. So like they are investing money in the US, even if it's way smaller numbers. So, and a lot of that money needs to come to the US, right? Like if they're raising money in Japan and investing in the US, they got to buy dollar yen. So if you look at like basically now the dollar goes up in New York time and it just does nothing in the other time zones because the other time zones, those people have done what they needed to do. So that was a structural thing. And FX you can always look at as cyclical and structural. And now for the next leg of the dollar down, if we're going to get that, you need a cyclical story. You need like US recession or disinflation in the US. And essentially you need 2-year yields to go lower, because that's the other thing about these FX hedges is that it kind of is expensive to just sit there short dollars. Like if you're long NASDAQ and short dollars, and you just like being very simplistic about it, if you're just short dollars for a year, it costs you 4% as a foreign investor. So that's no joke. As you know, compound that over 10 years, you could be hedged for 10 years and NASDAQ goes up every year and you lost, 1.04 to the 10th on your hedge. So that's not very good. So that's one of the things that has kept the dollar from really crapping out, is that it's just super expensive to be short dollars.
Tell me a little bit about what's going on with the dollar CAD thing. You've got some interesting Canadian thoughts.
So the just going back to like the whole anti-fragile thing, I guess a lot of the surprise in the US economy has been its resilience. And I think some of this is hindsight, but the resilience came from excess savings, from a lot of money flowed in because of interest rate hikes, because people on fixed incomes got more money from interest, but everyone's liabilities are frozen at 2.875% on the 30-year mortgage. So you have essentially like fixed liabilities and floating asset, in the US. Whereas in Canada, most people have variable rate mortgages. And then, so they're resetting, and you had no deleveraging in 07, 08, like US consumer debt and housing, like US is like this, and it peaked in 08 and it's like pretty decent. Canada's just like to the moon and it never even dipped really. And so you have a lot of consumer leverage, you have variable rate mortgages, which is bad. But one thing I've always said is that, so in Canada, it's non-recourse. So, it's recourse. So if you default on your mortgage, it's really bad in Canada. So if you have a job and your mortgage payment doubles or whatever, you just figure out a way to do it. You figure out a way to pay your mortgage, even if you have to max out a credit card or sell your car or whatever. But if you're unemployed, then it's game over. Like there's nothing you can do. So you're starting to see that now, like unemployment has gone up a lot in Canada. It's gone from 5.0 to 7.1%, which is a pretty big move. And you see it in like condos in Toronto that people bought pre-build for 900K are trading at like 620 and stuff like that. So you're starting to see essentially what looks like an over-levered economy start to crack as unemployment rises, because once unemployment rises, you can't, then you see who's swimming naked kind of thing. So I'm trying to do it through the currency, but really what I'm playing is more like a second derivative thing, which is I think that in the short run, the market's going to start to see the same thing I'm seeing, which is that the data is really bad. Like GDP is negative. Like the data recently has been really bad, negative job growth, negative GDP. And so a lot of times that's what I'm doing, is not saying like, hey, there's going to be a recession in Canada, let me be short, CIBC for the next 2 years. It's more like the market has been seeing these cracks develop, but no one really, it's more of like a fool me once, fool me twice, fool me 20 times thing with Canada, because people have been complaining about a housing bubble in Canada since 2013. So nobody wants to do the trade, but at some point it becomes clear enough that everyone wants to do the trade. And so what I'm trying to do is like catch that inflection point where hedge funds and even real money and hedgers and equity investors start to look at it and go like, you know what, I can't ignore this anymore. There's just too much evidence. And then, so the trade there is like short the currency, or the poster child, and this not investment advice, but the poster child for the Canadian housing market usually is CIBC, because a lot of the analysts, and I'm not a mortgage analyst, so what I normally do is like I defer to the experts on this stuff. But like a lot of the mortgage experts feel like CIBC's portfolio is the most vulnerable. So what I'll do with a trade like this is like, I'll take a shot. I'll buy like, say, I think the CIBC options that I would look at were like in October or October 17th or something like that. So I'm taking a shot, but I'm not committing to like some long-term scenario. I'm more seeing the evidence and thinking, okay, I can be early, like a little bit early, and then other people will probably be seeing the same thing I'm seeing. and react a little bit slower. And then, we'll be in a world where everything Canada looks quite a bit worse by October.
And this feels like one of those things that once this starts happening, it likely just accelerates from there. That's kind of the
Yeah,
for this.
I mean, there's like some aphorisms like narrative and price sets narrative or price determines narrative or whatever. My view is more like they're interconnected. But yes, when things start moving, that attracts more eyeballs. And then if the story is bad, those eyeballs are then going to turn to button pushing and people putting on the trade. And then also there can be ripples into the real world too, where, like say Canadian bank stocks sell off 7% one day, then that creates a tightening of credit in Canada, which then can have like a spiraling impact. So like there are also ways that price actually feeds the real economy at some point. And so yeah, and generally if you're too late, like to me, you kind of have to anticipate these things a little bit. And like everyone always says, like the cliche is like early is wrong, but late is wrong too, really, honestly. You have to kind of be like for my style of trading, you have to be a little tiny bit early, but also see the catalyst and see that, or have a view that people are going to recognize what you recognize pretty quickly.
Well, let's jump to another favorite topic of the Fed. And have they just become a political institution? You've been writing a lot about this pretty thoughtfully here. I want to not just pick
Yeah,
Canadians today. What happened
it's
with the Fed?
so it's a continuum, right? Like people have written, like people that are more apologists have written, well, it was never an independent institution. They cut right before the election. Look at Arthur Burns, look at what, Minsky said in 1962, whatever. And it's true. Like a central bank is not, independent, but it like neither are markets efficient, but they're still pretty efficient. So it's a spectrum. And having someone who's employed by the White House on the Fed is not normal. And it's definitely like a move on the spectrum towards less independence. And when the president of the United States says, I want to get a majority on the Fed, like it's not even, like they're not even pretending. It's just, I want to control the Fed. And that means lower rates. And the thing to me is, if the US economy slows and inflation falls, it's almost meaningless in a way because they're just going to do what they would have done anyways. And like, yeah, they might do it a bit faster. And there's some curve stuff you can do. And May 2026 is on the calendar, whatever. But the really interesting scenario is if inflation picks up, because then you have like a little bit more of a mini Turkey Erdogan situation where, orthodox economics suggests that you should be doing one thing and you're going to be doing something completely the opposite. So when inflation is rising, you should be on hold. You should be on hold, restrictive / tightening, and they're going to be cutting. And then that's the one thing that I think could unleash like a new bond vigilante trade and sell the back end. But you need inflation to happen. And so this again is a thing. To me, it's a lot easier to wait and see the inflation numbers and react and think about what the market's going to do than to have some kind of like 12-month view on inflation that I can forecast better than private economists where inflation's going. Like, I don't think I can do that. But what I think I can do is kind of suss out, okay, this is going to get scary with if XYZ happens. And then I have my little note of what XYZ is. And when it starts happening, then I can make the trade. The stupid thing about the bond vigilante trade is that it's always temporary because the government will always intervene. Like in the UK, once gilts sold off enough, the Bank of England, who was actually doing QT at the time, so they were actually in a program to sell bonds. They came in and said they were going to buy unlimited amounts of bonds. And, the US will do yield curve. If the Fed's cutting and inflation's going up, the Fed will end up doing, or sorry, the government will end up doing yield curve control and, pegging yields. And, so eventually the short bond trade for like the whoops trade is always temporary because they'll always change the rules and intervene or allow banks to buy bonds or whatever. So it's always a trade, never like a long-term thesis.
Is there anything else inside of that too? And I'm thinking about this in the context of both the Jackson Hole kind of flip-flop situation and also what you said before about the pension funds and Liberation Day, where it's just like one big adjustment. Like we have one thing we have to get in front of, and then we're going to sit back and we're not going to act more. Is there something with this where if the Fed makes a policy mistake where a bunch of other actors or vigilantes do one thing all at once and then nothing else happens after?
Yeah, I think you could see that. Like, I think there is a point if inflation starts going up in the US, that it'll feel a little bit like they're trapped, and foreign owners of US treasuries will become concerned and sell. But like I said, at some point the Fed will just be the buyer of last resort, and they'll do what the Bank of Japan's doing and what the Bank of Japan's been doing for a million years. But yeah, I think it's a possibility. It's just because really rising inflation and a central bank cutting is like literally what's happening in Turkey for the last 5 years. And if you look at a chart of dollar Turkey, it's like a perfect 45-degree angle of Turkey weakening and dollar strengthening, because you're manipulating real rates to the point where owning fixed income and owning the currency is a bad idea for foreigners. But I mean, all that hinges on rising inflation in the US, and where's that going to come from? I guess maybe a little bit from tariffs, or just from psychology of people, companies just saying, we can raise prices, so we will. But I guess we'll see. I mean, I think now we're getting far enough past Liberation Day that we'll see if that psychology, because tariffs, as everyone knows, are like a one-time price level change. They're not inflation. But that one-time price level change can lead to inflation if businesses decide that it's an opportunity to raise prices, and then they just keep raising prices. And then you go into your private school, budgeting meeting, and you say, okay, well, prices are going up. We better raise tuition by 5.8%. And then you say, well, but if we do that, and inflation's been really high, I guess we should raise the teachers' salaries by 5%. And then, and then you get some kind of spirally, a miniature inflation spiral. So I think there is like some kind of possibility of that. I don't know. I guess for me, I would put that in like the tail risk area, like 15% chance that inflation goes up, the Fed cuts, that spurs more inflation, and then a lot of bad things happen temporarily. Although I say temporarily, like it'll feel like the global financial crisis when it's happening. I mean, that was temporary too, I guess. So is life, I guess.
So it goes. That's Vonnegut.
Yeah, in the long run, we're all dead.
All right, 3% is the new 2%. Are we still there, or is it no longer 3% anymore even?
Yeah, I think honestly, like inflation targeting in the US is kind of dead. Like if you look at it now, for years, and this is like before Trump, before tariffs, they're forecasting inflation above target in their SEP, and they were cutting at one point like a year ago. So I would say they don't really care about 2%. Like in their mind, 3% is probably fine. And knowing where deficits are and all that, what you really want is like nominal growth. I don't think there's a big conspiracy where they're like trying to run it hot in order to get rid of the deficit. But I think they're just kind of like, whatever. At this point, it makes no difference whether it's 2.8 or 2.1. We'll just keep saying we think it's going to target. And if it stays at 3%, I mean, I think we've been above target for 53 months in a row. So, I mean, how can you take the target seriously? Like, obviously they don't care about it at this point. Inflation targeting as a concept started in 1997. It started in New Zealand, but a lot of the central banks were kind of, considering it and acting on it since 1997. And there's never been a run of more than like 20 months above target in the US, and we're at 53 months now. So I think it's just like a big, I don't know if kayfabe's the right word, but it's just like, they just say stuff and they don't actually mean what they say.
Well, here's the snapping at the Slim Jims and all the other lessons that we really should derive from K-pop and professional wrestling.
Is it pronounced kayfabe?
You tell me.
Oh, I don't know.
We need cooler kids on this podcast. Neither of us do.
That's one thing I find interesting about listening to audiobooks is I've learned some weird pronunciations. Like I never knew, I always thought it was fiefdom, but it's fiefdom. Like I just had the wrong pronunciation in my head. But there's like certain weird words like that where I hear the pronunciation in the audiobook and I'm like, wait a second. Like the last 30 years I've been pronouncing this word wrong. But anyways, that's not what we're talking about.
No, and I've also heard words that I knew they were pronounced other ways on audiobooks that have led me astray.
Oh,
Where
oh,
I've gone like, oh no, this guy doesn't know.
oh yeah. Sometimes the bad YouTube readers are like that. Like they're like the parquet floor or whatever.
Yeah, yeah, yeah. That'll really throw you for a loop too. All right, I'm steering this higher, but probably not for long. I want to talk just more philosophically for a second.
Sure.
Avoiding becoming a perma-bear when data turns negative, because I feel like we're on the cusp of some of these data points again, and people who just want to do the bear porn thing. I mean, this is how YouTube works too. This channel would do way better if all we did was rain bearishness on people. You said, I think this is 2023, I will never be a perma-bear because that is the absolute biggest leak in finance.
I mean, it's true. It's a good way to sell podcasts and all that. And that's one thing that I found really frustrating about Twitter is that you end up I find myself self-censoring sometimes because if you're going to write something that's like kind of sane and a little bit bullish, nobody sees it. It'll only get 42 likes or whatever. But then sometimes I am bearish, so I'll put the thing on and it'll get 1,200 likes. And so like everything's tweaked that way. There's a really good chart from FT Alphaville that came out in the last couple of days where they looked at sentiment of all FT articles back to 1995. And you can basically imagine what it would look like, but it's getting more and more bearish. And it's the same thing with mainstream publications, just more and more negative. So you're just being fed this constant diet of negative information, and yet look at a chart of like S&P 500 since whatever start date you want to pick, and or the dollar has basically been a cyclical currency with a structural doom narrative since I started in 1995. So I feel like you have to inoculate yourself against what is just like constant poison coming from the media, because everything's negative. But then also you just don't want to be positive all the time because that's not right either. So I just feel like you have to be like aggressively agnostic all the time. And I mean, I guess one way to avoid the perma bear thing, like that's easy for me because of my time horizon, is I just have stop losses. So like even on a narrative, sometimes you can put a stop loss. Like if you say like, okay, I think the AI CapEx story is peaking. We saw DeepSeek and that was the first scare, but now it's, I don't know, Broadcom is going to compete with NVIDIA and there's too many people with not enough moats or whatever your thesis is. If I had a thesis like that, then I would probably say like, given my knowledge of what NVIDIA's price looks like and all the tops at like 185, if we go above 190 in NVIDIA, I'm just going to say like, I'm wrong. So I think that's one of the most useful aspects of technical analysis is that it just gives you the opportunity to say, okay, this is my reassessment trigger. If this happens, I'm wrong. And the beauty of technicals is that it just gives you like a number. So, if this thing trades, if 10 years goes below 4%, then my, view on yields is wrong or whatever. So that's ultimately, I think, my like fail safe is that even on either on like bigger, stronger views that I'm taking that are macro, or I mean, 100% of all my trades, I always have a stop loss. And I think like that's a simple way to inoculate yourself is that so you don't just keep on selling Tesla because it's overvalued compared to Ford or whatever. At some point your framework is wrong and the price will tell you at some point, okay, your framework is wrong. So it's time to change your view. The risk obviously is that you flip-flop too much, but it's a trade-off. And to me, like the flexibility and the like agnostic viewpoint is worth so much more than the cost of, yeah, sometimes I change my mind a bit too much, but oh well.
Because the stop loss as a forced agnosticism, right? Like the stop loss is literally forcing you to go, this is my view. Either I'm going to change my mind before this gets hit, or this is going to get hit and that's going to force me to reevaluate.
Yeah, generally that's how I approach it. And you can also have different like reassessment triggers that are not based on prices. Like you can say, okay, like if CPI comes in below zero point 0.2 for the next 3 months, I'm going to give up on my reflation thesis because obviously the data is not confirming it. And sometimes I'll put little notes for myself, like based on that kind of thing. Like, if NFP is below 50K for 3 months in a row, obviously the reacceleration is dead or whatever. I mean, that's too long for me to wait because I couldn't wait that long. But but like having macro reassessment triggers is just as valid as having price triggers. And like, sure, obviously sometimes the price can be wrong, like markets can be wrong all the time. But if you never have any kind of reassessment trigger, it's just too easy. Like I was saying in 06, 07, just to keep getting more and more bearish as the thing goes up. And then when it finally goes down, you've been stopped out so many times and your account has lost so much money that you have zero leverage on the trade. And then one thing I will do though is like I will take the same view a couple of times. If there's a reason, like if I'm bearish AI and then I get stopped out, and then a week later DeepSeek happens. I mean, I'll be like, okay, I'm going to resell at worse levels. I don't care. There's new information, and the equilibrium. Maybe my prior view was wrong, but now we have new information, and I'll go for it. So I'm not always like I was bullish, then I was bearish, then I was bullish, then I was bearish. Sometimes I'll just be bearish, get stopped out, and then, nothing has really changed other than the price. And then something else happens and I get bearish again. So ultimately, like just being flexible. And like, I think that can have a cost if you're like a long-term investor or whatever. But as a trader, like I said, yeah, it definitely has a cost, but that cost is lower than the cost of inflexibility.
Inside of that, and I'm putting you a little bit on the spot for this one. You have this story. This is about humility. And it's always stuck with me. So hopefully it's stuck with you too, because now you're on the spot. 2021, I think it's a question at dinner about Fed forecasts. And it was like, go around the table. How many 25 basis point hikes do you expect?
Oh yeah, that was crazy.
Do you remember this story?
Yeah. I mean, I even remember where I was sitting. And because I remember there's one guy that was at the dinner who's like,
so where are you? Who's hosting this dinner?
It was actually me. It was when I first started at Spectra, and I did a dinner at Milo's, which is a very good place to do dinner. In a private room, not in the main place because it's too noisy otherwise, but in the private room. And there was like a bunch of hedge fund PMs there, and like John Turek, who's a really good macro guy, was there. And it was like in the is it transitory, is it not kind of place. But I think most people thought inflation was not transitory. And so, excuse me, we had a vote of like, how many Fed hikes do you think there's going to be in 2022? And most people said like 3 or 4. And one guy said 6, and everyone like basically started laughing. And there were 17 hikes of 25 basis points in that move up. So like some of them were, they hiked 75 once and stuff, but it essentially, the guy who was like getting laughed out of the room for being too hawkish had 6, and the correct answer was 17. And it's crazy how often that happens. Like it's just, it's so hard because you can't just go around making ridiculous calls all the time either, because like that's what Kathy Wood does or whatever. And it's just, you lose a lot of credibility because at some point people realize that you're just marketing. You're not actually serious about what you're saying. But at the same time, it's good to have an imagination. Like if you think, something major is happening in the world, whatever you think the security market or like the capital market response is going to be, it's almost always way bigger. Like when Abenomics happened, people were like, oh, dollar yen could go from 75 to 95. This is a massive sea change. And like dollar yen went from 75 to 160. So I think in the moments of, essentially when there's a regime change, you can, and you're like, when you're betting on a regime change, like going from cuts to hikes or whatever, it's great to have an imagination. And you don't always have to say like, okay, I'm going to bet on 17 hikes, but having an imagination that like people tend to herd around a median that's way too conservative when it comes to like, it's the same thing with economic data. If you look at like the distribution of forecasts for economic data, it's always way too herded right around the median. And like very often an economic number will come out. So like 65 economists submit their forecast to Bloomberg, And quite often, the actual result is outside of the range of all 65 economists from low to high, because like that's how humans just tend to herd around. If the world is saying one thing, it's really hard as a human being to like think radically outside of that. And I mean, that's ultimately what good trading is, and what good investing is having a view that's completely different from what the real world, like what the world's view is, and then figuring out how to monetize it.
Always. I always look at survey data. I used to always tell people and say, the point of the survey, if you haven't encountered this before, is to tell you what vanilla ice cream tastes like. And
Yeah.
you're going to go to the store, Baskin Robbins, Turkey Hill, like whatever your regional appropriate ice cream store is, you're not getting the vanilla. Like you want the Rocky Road or something. They're telling you what vanilla is, but you want something better. And you got to think
Yeah.
about, if this is vanilla, what better thing can I come up with?
Right. And the part of it too is that you're asking generally in surveys for a point estimate. So like you're not asking the person to give a range of forecasts. So
Right.
the natural thing is that will cluster around the median. Even if, the guy at Goldman Sachs thinks the range is 100, points wide, he's still only giving a point estimate, and that point estimate's going to be like in the middle, obviously.
Yeah. You have to understand these questions. Okay. So with the philosophy of this, with the agnosticism of stop losses all combined, you were telling me before about you're using LLMs to day trade.
So,
How does this all come together? Because I see these things as related. Maybe I'm crazy, but what are you doing?
so I don't know how far to go into this. I'm writing a new book right now, and it's essentially a follow-up to Alpha Trader, but it's trying to go like outside the box of like technicals, fundamentals, behavioral and quantitative are like the box, right? That's like every trading book, including my books, are generally inside that box. So I'm trying to go outside of that and talk about like gambling addiction as it relates to overtrading, or, poker as it relates to risk management, or LLMs as they relate to information gathering. And I've actually been using LLMs a lot. I think some of the use cases are pretty obvious, but even though they're obvious, they're shockingly good. So, like, say an example is like a headline comes out, and I'm not a biotech guy, but I like trading headlines because I feel like that's one place, like, if that's one place where markets are just clearly not efficient, is if you believe in a theoretical world where markets are efficient, then there would be a singularity when events happen. And, the stock would go from 25 to 50, and then it would trade at 50, and it would range trade between 49 and 51 because the invisible hand would put it there. But that's not how it works. Like there's stale orders, and there's people that read the headlines wrong. And so anyways, there's always a continuous shift in price when events come out. So I think that's like, there's a big alpha opportunity in trading events. And my history kind of proves that. And actually, Unknown Market Wizards, if you read that book, has a lot of event traders in it. So anyways, but the problem is like, uh, there's not quite enough headlines to just constantly be trading headlines, obviously. So what you want to have is the largest possible stock of headlines that you can trade. And in the past, if I saw a biotech headline, like I just like jumped away from the screen, because I'm like, not only do I not understand it, but I'm like the sucker, in the biotech trading world. Like I have no freaking
Cancer's
clue.
been cured so many times
Yeah, yeah. And
in the
I
Brent
buy the stock,
verse.
and you
Yeah.
buy it at 8. It goes from 6 to 8 to 2, and you're like, oh, I guess it wasn't as good as I thought.
Yeah.
So what I've been doing is like, so there was a headline the other day: Cytokinetics PDUFA extended to December 26th.
Of course.
And I'm like,
Obvious.
I don't know what any of those words mean, but it's a red headline, and I'm bored. It's like 5:15. So I put into Claude or ChatGPT or whatever, and I just say something like, are these important headlines? Estimate stock price impact, give a confidence interval. And the thing spits out like, so then I'll use some judgment. Like I'm not just going to do whatever the thing says, but it spit out like, there have been 4 other PDUFA extensions in the last 3 months. All 4 stocks dropped 8 to 15%. This, that, whatever. And the stock was down like 2%. It was like, it had barely moved. So I was like, okay, well, this seems pretty good. Like sell 2,000 shares, and it dropped like another $5, and I made 10 grand or whatever in 15 minutes. And like, obviously that's like the dream scenario, but I don't really find it's wrong that much. Like if it's wrong or it's hallucinating, I feel like generally you can kind of tell. So the biggest issue with what I'm describing is it's obviously super slow, right? So I'm putting it in and like headlines don't always like the price doesn't always wait around for you. Um, but sometimes it does. And if it doesn't, then you just gotta be disciplined and not sell it when it's already down 14%. So that's one use case that I've found, and like that's not just like a crazy like edge case example. Like I'm finding it useful all the time for like anything where it's a little bit in the weeds. I mean, I literally a lot of times just say like, what does this mean? And I just cut and paste the whole story and put it in. And then also sometimes it will lead me to like further research, like this whole, I don't know if you're familiar with the Echo Star situation, but there's been some
So what
crazy
what is
trades in
this?
it. So Echo Star is like the old Dish network, and
Okay.
they own a bunch of bandwidth, or like is that what it's called? Yeah, like broadband, like bandwidth. Yeah,
Broadband. Yeah, yeah.
yeah, bandwidth. And they weren't doing anything with it. So the FCC was giving them a hard time and basically saying like, you guys got to do something with this. And they have like $23 billion in debt. So the guy said, if they take away our broadband, because they were threatening to take it away, we'll go bankrupt. So the stock was like at $20. It went, I think it traded at 10 that night or something. And then it just kind of dicked around and for a while. And then they sold one clip of their broadband to AT&T for 23 billion. Then they sold another clip to like not SpaceX but some Musk run thing for 16 billion. And when this was all happening, like all these headlines were coming out, and each one of them, like I was able to pump it in and like, no, they will not go bankrupt. This is actually just a play. Like basically it was a ploy to say like, to try to get the political situation on side or whatever. And like, so the interpretations of the headlines were really good. Anyways, my only point here was that it's not a one-off. Like I found it useful like quite often. Um, the second thing that it's really useful for, tell me if this is getting boring. I can't tell. Is it?
No, I'm fascinated that
It's fine. Okay. Okay.
you're using
So,
this in this way. This is really
okay.
good.
Okay. So this is a completely different thing. So say one thing that I like doing is shorting like bubble things like the crypto treasury stocks and whatever.
I was going to ask
But
you about this anyway, so perfect.
but it's suicide to short these things generally because depending on the thing, like they get halted. Also, they can just go parabolic and like it. So what ends up happening if you short them is you have to take a really small position, and then when you do catch it and they do a secondary and it drops $50, you're like, oh, I made 5 grand. Like it was a lot of angst and watching price watching for to not make very much money. So generally what I do is I sell call spreads, like something like CoreWeave or Bitmine or whatever. There's options markets and the vol is super high. So you can sell call spreads that pay 1 to 1, and you can do it in whatever size you want essentially. So that is just, that's a preview to what I'm saying. But what I'll do is sometimes if I'm like trying to think of, so that would be a thing where I already know how to do it. But if you didn't, you could type in like, CoreWeave's trading at 145. I think it's going to 110, but it's not actually, a lot of times CoreWeave's not shortable. So it's not shortable. I'm reading a thing here that I had written. I want 3 option structures that work in my scenario, but don't give me any ideas that are unlimited downside. Limited defined loss only. Can use calls or puts. Show P&L profile of each strategy using an x-axis that goes from 100 to 170. CoreWeave stock price at expiry, 7 days to expiry. Implied vol is 95. Assume I want to risk $20,000 on the trade. So I'll put all that in, and the output is not too shabby. It's like it gives you like 3 different ways of approaching it, like bear whatever put spreads, bear selling call spreads, buying put spreads. It shows you the payoff profile, because like the one thing about comparing these strategies is doing the payoff profiles is a lot of work unless you know what you're doing. So getting the LLM to do it is really nice. And then it'll spit out like a pretty good answer. And then the other thing you can also do is just like say I've got an idea. I think dollar CAD's going to 139 in the next 2 weeks. I'm not sure whether I should do spot or vol. Give me some things to consider. So like essentially trade structuring. Should I do cash? Should I do options? Should I buy options? Should I sell options? Whatever. So that's the second thing that I've found. It's pretty good. It does give you wrong answers. Like, I think generally the way I look at these things is, maybe everyone knows this. I don't know. So maybe this is like a stupid thing to say, but the way I look at them is like idea generation machines, but not calculation or right answer machines. So like they're spitting out a bunch of ideas and like caveat LLM or whatever, like just be careful because they can be wrong. Um, and then one other thing, I mean, there are other things, but the last and most interesting thing, um, in my opinion, I don't know. Sometimes I just can't tell if something's interesting to other people, but to me it's interesting, so I'll just talk about it. But I'll take, like I'll get open, high, low, close data for a stock. And again, I'm just gonna read the prompt that I put just instead of trying to remember it. So I'll take like out of Bloomberg and put it in an Excel spreadsheet. So I drag the Excel into ChatGPT, and then I'll just say, "You're a professional Wall Street analyst. I need a cheat sheet for this stock. Take your time, go slow. There's no rush." I find telling it to go slow tends to get better output. Like give the average daily high-low range in percent, 1 standard deviation and 2 standard deviation moves. Tell me the biggest up day, biggest down day, 50, 100, and 200-day moving averages. And if I'm trading a stop loss of 1.5 times average daily range, use the current stock price to tell me how many shares I should trade if I want to risk $10,000 per trade. Make it a one-page PDF that I can print on my desk or whatever. And then it'll spit out a pretty good thing. Like I did it for MicroStrategy in this example, and it gave me like, okay, 1 standard deviation, 2 standard deviations. And like, cause I trade MicroStrategy, I know, like I can eyeball it and know like, okay, that's totally wrong or that's not. But in this case, it was right. It showed me all the moving averages, and, it said, if you want to risk 10 grand and average range is 7%, so your stop should be 10.5%. That's $39.22 per share. Therefore, times, if you're risking $10,000, 300 shares or whatever. So I found it useful for basically put financial market data in there. And then one last thing you can also do is just say, give me some ideas that might pop out if I were to back test this. Like, tell me anything interesting or unusual about this data that might help me trade MicroStrategy better. And it'll spit out stuff like, in this case, it said next day is mean reverting, RSI extremes are this, big down, intraday bounces, more than big up, continues, like whatever. It basically does like a really basic data mining exercise. And again, like you should not just be using this, but it's a great way to get ideas, because then you go, oh, interesting. Like I didn't realize the skew was that substantial. For example, in something like dollar yen, I know what the skew feels like, but in something like MicroStrategy, honestly, I wouldn't really know. Does it go up faster or down faster? And so this will give you ideas for that kind of stuff.
I think it's fascinating because of the pattern matching ability to it. And so
Right.
it's really interesting for somebody where, and you tell me if you think I'm wrong on this, you had to train up your ability to see and sense some of those patterns to at least have a feel of what this stuff looks like. But if you have a little bit of a feel for what this looks like, or what you go, something bugs me, even if I can't exactly recognize what bugs me, you can go, I'm not going to fully trust this.
Yeah, I think it would be very dangerous for someone who doesn't have a lot of experience trading a particular security, because there is garbage that just comes out of there that's completely wrong.
Yeah.
But again, as a starting point, it's just like there's too many patterns for even an experienced trader to look at a data set and just know all the patterns or find all the patterns. You're just going to forget. Like that's what I find a lot of times is like, oh yeah, I forgot that, I used to use this thing where if RSI got below 20, the bounces were whatever, like there's so many patterns that you've seen over your lifetime. So, and then sometimes it just spits out something and you're like, whoa, that's crazy. I never even thought of that. And then you can go back test it, and sometimes it's right.
All right. So I made this note back when we were talking about Dalio and the all weather, and kind of how you have to be seasonal about trades. And I got to ask you another really pointed question before we wrap this thing up. I feel like we might have talked about this before, but maybe not, just because it's such a bizarre moment in history. Do you remember when you're writing about Radiohead? So first I want to shout out, what was it, a French version of Creep? What was the thing you
Oh
showed?
yeah, yeah, it was French. Yeah,
Ridiculous. Do you remember who that was? That was so
it was just a random person. Like it had quite a few hits on it, but it wasn't like a well-known artist or anything. It was just like some woman in her bedroom doing creep in French.
and it was really, really good. So
Yeah,
first
it's
off,
beautiful.
we're gonna find that because it's fantastic, and it's a great. I'll tell you what the distraction is for that way. Do you remember when Radiohead played at the Beach House for MTV in
No,
1993
no.
or around there? Okay, perfect. Like all weather gone awry. So first off, York is wearing like long sleeve shirt and jeans, and they're doing Creep before it's a big hit, but it's kind of a hit at the time, and nobody knows what to make of these guys that look like a disaster. And then they play.
I gotta watch this.
This is great. It's on YouTube, and I think the full cut is on there because I feel like I discovered this a couple years ago.
What's it called?
It's the MTV Beach House
Okay.
Radiohead performance from
Yeah.
the early to mid 90s.
I'm just opening a tab so we don't forget. So I don't forget.
Please find this afterwards. So if you can find the unedited cut that I don't think aired on TV, after the second song, Anybody Can Play Guitar or something like that. I'm blanking on
Yeah.
the name of the song. He jumps in the pool. So fully clothed, not seasonal investor, but about to
Oh,
change
God.
the face of modern music, Tom York dives into the swimming pool, then proceeds to come back out. And he goes to like jump right back in and grab the microphone, but he is now
Oh,
this like roadie like ninja kicks the microphone away from him.
oh, that's awesome.
Probably saves his life. So I think the lesson here is like you want to be a little bit of all weather aware. Stand out when you want to stand out, but God, don't do something stupid like hold onto the microphone when you're
Yeah,
sopping
that's
wet.
actually a good way of looking at it too, is that even if you don't have like a position that is suitable for all weather, at least be open to the weather changing. Cause like I think that's part of what people do wrong is they have a hypothesis and then they just like, that's what confirmation bias is. They find information that confirms it and they don't really think like, okay, what if I'm wrong? They just think about in a more deterministic way of how right they are, And I don't know, I guess the more time you spend in markets, you're just wrong so many times that after a while you just can't deny that, hey, I'm going to be wrong. So I'd rather be ready to be wrong than pretend I'm not going to be wrong.
Yeah. And there's joy in being wrong or finding weird stuff,
Yeah.
like French covers of Radiohead songs. Brent Donnelly, people want to follow you, bug you on the internet. Where should they look you and your good friend Brute up these days?
SpectraMarkets.com with Spectra with an A. Everything's there.
SPECTRIA, right? Spectra? Did I get that right?
SPECTRA.
Yeah, let's
You
get
threw an I in there.
Who knows? Rewind that. Catch that. Look at Brent's stuff. At least get the weekly email. That's free, right?
Yeah,
Everybody can
Friday
get the weekly
Speedrun is
email?
free. So yeah, people can sign up for that and see if they like the flavor. And if it's too vanilla, then who cares? It's free. And if it's Rocky Road, then party on.
All right. Party on, Brent.
Party on, Wayne.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.